All right, if you're a Cathie Wood fan, it is time to talk about this 24-minute article that this woman released 3 days ago. We got to get into it. We got to dissect it. This video is meant to make it super, super simple for anyone to understand what the heck she talks about, because it is kind of complicated if you try to read it on your own. There's a lot of random words that she's using. You got to look it up and like, oh, this just means innovative. Why are you using another word? Why can't you just say innovative? But nonetheless, there's a lot of good stuff in here. There's a lot of deep stuff in here. Now, overall major takeaway before I get into the nitty gritty of it, she does not think that tech stocks, particularly high growth innovation tech stocks, are in a bubble. She actually thinks they are in what she calls deep value territory. So she thinks the entire market, everyone, especially the people that are shorting these stocks and that are selling off these stocks, are completely wrong about the growth potential and trajectory of these stocks due to the fears of things that are happening in the macroeconomy that we're getting into. And she also believes that because they're so wrong, the bets that they're taking in value stocks, something like an Apple, Costco, etc., more of the safer stocks, are actually worse, and they're going to hear and feel the ramifications of those stocks over the next 5 to 10 years when disruptive innovation happens. So there are sort of 6 main categories that she talked about. We're going to talk about each of them. Not going to go super technical, rather going to try to break down the technical stuff she talked about and make it more understandable for the everyday person to really understand what's going on. Again, the overall takeaway is that you should keep investing in growth tech stocks if you believe in her thesis. If you don't believe in her thesis, then you should put your money in something more safer like the S&P 500, etc. But she actually thinks that it's not that safe. So that's why we're going to get into it. Okay, first thing she talked about are quant strategies and algorithms exacerbating inflation fears. So first of all, what is a quant strategy? A quant strategy in algorithmic trading is basically when the market conducts trades based upon algorithms. So like they just happen because the market has these things in place where the market has these different trades. Their research says that about 70% of all trades that happen in the market are algorithmic. So, if you go on Robinhood and you decide to buy a share of Tesla and then sell a share of Tesla, that's you as a retail investor buying and selling a share of a company. With algorithmic trading, big institutions, hedge funds, Citadel, one of the biggest ones, they have these mechanisms in place that they spend lots and lots of money on to be able to create that basically detects patterns that are going on in the market and then does trading based off those patterns, whether that's shorting a stock, selling a stock, buying a stock, etc. And they make money based upon the 1 to 2 cents in between these millions of trades that happen every day. Their argument is that because tech stocks started selling off about 3-4 weeks ago, these algorithms just tried to match those patterns, and that's what led to more and more of the selling off. It's kind of like a snowball effect. So once these algorithms recognize, oh, the money is shifting from here to here, more people are shorting these stocks, more people are afraid because of inflation, then the algorithm kicked in into hyperdrive, which led to the massive sell-off, which is what leads most of these prices to go up or down, right? It's not just you and me, retail investors, buying stuff unless it's AMC. It is algorithms actually dealing with this stuff. So because of this quantitative trading, she thinks that everything is wrong. And this is sort of the first quote that I want to read that starts off the thesis of what this article was about. They say, if our research is correct, companies myopically focused on short-term profitability and they have not yet invested in capital on the explosive growth opportunities associated with the 5 innovation platforms that have been germinating since their seeds were planted 20 years ago in the tech and telecom bubble. Instead, many are likely to suffer from creative destruction, which we'll get into a little bit more. Even the FANGs could be in harm's way as the convergence of blockchain technology, artificial intelligence, and the metaverse attempts to destroy the roles of centralized data aggregators, ceding economic power to creators and consumers. So she's basically saying that, look, there's a lot of disruptive innovation happening within the tech space in particular, and the traditional FANG stocks, the Google, Apple, Netflixes of the world, given their centralized approach towards how they integrate with technology, could be disrupted via decentralized blockchain approaches as well. Now, I don't think she's correct on that. I actually think she's dead wrong on that. But that's sort of her entire point, which is that a lot of different things are happening that are going to creatively disrupt the way in which the world operates, which is why investors should be more worried and less quantitatively, algorithmically focused on trading stocks, but rather more focused on what's actually happening, what seeds have been planted over the past 20 years when it comes to disruptive innovation. Now, next thing that she talked about are other markets engaging with fears of inflation. So the cool thing about this part of the article was that she's like, look, we actually like that people are thinking there's a bubble in disruptive innovation stocks because there's no way it makes any sense because there's not a bubble in anything else. The S&P 500 is up 30% of the year, and everything else is at record valuations. You look at something like Apple, it's almost at a $3 trillion valuation, and nothing has really changed over the past year, like other than them introducing the iPhone 13 that no one bought, right? Or that's not that different from the iPhone 12. So like, yes, are they making a car? Are they having a headset? Sure. But like all of this stuff is all speculative. And to value a company at $3 trillion when it just gained like $1 trillion in market cap in 2 years is kind of insane. So if you're talking about market cap and bubbles, you would be thinking that the traditional stocks that are carrying the S&P 500 and the NASDAQ are actually the stocks in a bubble. Because growth stocks have sold off so much, this part of the article that says other markets are not corroborating fears of inflation seems to suggest that this is the best opportunity to buy growth stocks because of how heavily undervalued they are and how heavily overvalued the rest of the market is. The S&P 500, again, is up 30% for the year. That's not like a bubble. Or if that is a bubble, then it would have popped by now because the market is up really heavy over the past year. So her argument is like the rest of the market is up. They're probably in a bubble. Tech stocks are not in a bubble because they're so heavily undervalued and investors aren't recognizing how disruptive innovation is going to change the rest of the economy over the next 5 years. And we're going to get into that point a little bit later. So basically her argument is other markets suck. They don't understand that they're not cooperating with the fears of inflation. Only tech stocks are, for obvious reasons. But because of that overvaluation on those stocks, tech stocks are eventually going to make a rebound, and it's going to be pretty phenomenal when they do rebound. Now, her next argument is, could the risk be deflation? And this is something important to understand. There's two elements to why she thinks deflation could be the risk over inflation. And deflation just means that all like the prices for your milk going up by $1 or like by 50 cents is actually going to go down because the value of the dollar is going to deflate versus inflate, which means it's going to be more valuable over time. There's two components to this. Number one is Wright's Law. I'm going to make an entirely separate video explaining what Wright's Law is because it's too much to talk about right now. But the basic concept is there is sort of 5 main elements of disruptive innovation that she thinks is happening in the economy right now. And because innovation is moving exponentially, when this happens, costs go down. So for example, one of the things she cites is that the price at which it takes to train a AI intelligence model is going down by double year after year, which is decreasing costs of AI implementation into all the products and services we use, like our phones, like our Google Homes and laptops, all that stuff, by 40%. So if AI is going to be integrated into every fabric of society that we have over the next 5-6 years, which is why I'm a heavy investor in Palantir, because I believe in that. And the price of training AI is going down substantially. And for every price that it goes down, it's like double or quadruple the price it goes down to implement it into other things. That's kind of this exponential curve of how prices decrease. A good example of this is solar panels, right? So solar panels used to be really expensive 10 years ago, but as more and more companies started making them, the cost of them started decreasing exponentially because that's what happens when you have economies of scale. When you have thousands of companies around the world and factories producing solar panels at scale, the cost of actually getting the material for them decreases. So because she believes that Wright's Law is happening right now, and there's exponential growth within certain categories, particularly around innovation and AI, the costs for the macro level economics of society are going to decrease substantially, which is going to deflate the value of the dollar versus inflate it because costs in general are just going to go down. So this is her whole theory about innovation being a deflationary effect. Now, will she be right on this? I don't know. But logically, if you think innovation is going to be exponential over the next 5-10 years, and AI, blockchain, energy storage, autonomous vehicles, all this stuff is only going to increase more and more and more over time, and you're betting on her thesis, then that means logically costs for this stuff is going to have to go down, which is going to have an entire ripple effect across the economy because these types of innovative platforms like AI, for example, are integrated within everything that we do. So that's her first argument. Again, I will do another video explaining that even more deeper because that topic requires a video of its own. Second is this argument about consumption growth declining. So her argument is twofold. One is that supply chain bottlenecks, which is like how much things are held up within the supply chain, which is why we have less products, right? It's hard to buy a bunch of laptops because it's hard to get semiconductors and chips for those laptops because there's supply chain shortages, means that the price of laptops are going to go up, which means inflation is going to rise because there's more demand and less supply for these products. Additionally, consumers started buying things early because they were afraid they wouldn't be able to get their holiday shopping done, which is why we had these record Black Friday, Cyber Monday sales, which only led to more inflation because more and more people started pumping more money into the economy. In order to deflate, you have to make it more reasonable for people to not put more money into the economy, right? To not buy stuff. When we gave out stimulus checks is because we wanted people to spend. So we gave them money to spend. That stimulates the economy. When we don't want people to spend money, that's where you do something like raise interest rates. When you raise interest rates, that means it's more expensive to borrow money or to spend money, which means people tend to spend less money and the value of the dollar starts to go down versus up, which is good for deflation. So her argument is that consumption growth will decline. Consumers were just edgy over the past couple months because they weren't able to spend all throughout COVID and because they were afraid they wouldn't be able to get the products they wanted due to supply chain shortages, which means that as supply chain bottlenecks start going away and as supply chain problems start getting solved, and as more and more products enter the market, there's going to be less demand from consumers. Like, I need to get that laptop because if I don't get it, someone else is going to get it, which is ultimately going to lead to a deflationary effect. So she believes that the risk could be deflation over the next 6 to 7 months if Wright's law is correct and innovation keeps moving forward and prices start going down, and as if consumers stop spending money because there's not going to be a need to spend money at the rates that they are due to supply chain problems being solved. So that leads to sort of her final two conclusions, which is that innovation stocks are not in a bubble. They believe they're in deep value territory. Now, this is something you have to understand historically. They present the argument that in the 1990s, up until the tech bubble that popped in around May 2000, investors were so obsessed with chasing these stocks like pets.com and all these random companies that went out of business that they poured tons and tons of capital into these public companies because they really thought these companies were going to have network effects that were going to be exponential and change the entire world. Now, that stuff happened. It just happened later, around 2008 to 2000, you could say 20, for tech stocks. You're talking about Google, FANGs, all that stuff, Apple, Facebook, Netflix, right? Versus the random stocks like pets.com that people were chasing in the 90s. So a lot of people lost a lot of money because that bubble popped when they were chasing tech. As a result of that, they became more risk adverse, and when I mean they, I mean institutional investors, of putting money into high growth tech companies like Amazon, that was losing a lot of money, right? That went from $100 to $6 during the tech bubble. Now it's at $3,000 because they were afraid that there would be another tech bubble. They were afraid of trusting that these innovative stocks would actually be able to innovate because they lost so much money in the tech bubble. Her argument is that's the exact same thing that's happening now, that investors are super, super scared and risk averse, especially as the volatility index is getting higher. That's an index of how volatile a market is, and that's usually associated when it goes higher with a bear market. So because she believes that these stocks, the Teslas, the Palantirs, the Twitters, the DraftKings of the world, these companies are actually going to change things from a fundamental perspective on how society operates. They are the new FANG stocks, and we saw what the FANG stocks did and the value they created for the world, that investors don't get it, and because they're so scared, they're going to miss out on those tech stocks, which is why they believe they're in deep value territory. ARK does not believe that these stocks are in a tech bubble, because if they were in a tech bubble, it would be similar to around the 1994 era where there was just tons of money pouring into companies, tons and tons of people chasing Tesla, chasing Palantir, etc. But that's not happening. You don't see all these institutions chasing these stocks. I mean, even with Tesla, even with the growth it's had, you don't see a lot of people chasing it. People are still shorting it. People still don't think that it's going to become the thing that it's going to become. So her argument is like, because they are not in a bubble, and it would be very obvious if they were in a bubble, right? Their valuations would be absolutely ridiculous. Because they believe the valuations are not absolutely ridiculous, they think they're in deep value territory. And they think what's happening right now is what happened in 2008, where because people were so shaded by what happened in the 90s with the tech bubble, that they were afraid to invest in something like an Apple or Facebook, because they're like, what is Facebook? It's just a blog. It's not going to do anything, without recognizing the disruptive innovation that Facebook was actually causing in the social media space and how it would be the go-to place for advertisers 5 years from now. The same stuff is happening with the big stocks that ARK is betting on, hypothetically, right? That's what they believe. And because other tech investors are not recognizing that, that gives those stocks value over bubble territory, which is sort of their basic argument for why innovation stocks are not in a bubble in the first place. Last thing they said is broad-based equity benchmarks could be in harm's way because of disruptive innovation. So they have a belief that right now, innovation stocks account for about $10 trillion of market cap, and there's a $200 trillion market. So the scale of this $10 trillion, so you think of something like Tesla's robo-taxis and their DNA stocks that ARK is invested in, the biome sequencing, all this crazy stuff that's going to happen that's going to unleash massive amounts of market opportunity, especially in the tech industry, that's going to scale to what they estimate to about $200 trillion by 2030. Now, will that happen? I don't know. I mean, we really got to see how these tech stocks perform. But if they do perform at the level at which ARK says they're going to perform, a $200 trillion market is something that ARK is going to have all their hands over, and eventually investors are going to have to chase it, which means eventually these stocks are going to explode. It rests on the belief that broad-based equity benchmarks, things like Apple, the S&P, and NASDAQ, don't have the same capacity to creatively destroy the world like they did 10 years ago, right? Apple with the iPhone was creative destruction back in 2007. That's not the same thing that's happening now. Now, could Apple do something that disrupts the world and innovates the world? Absolutely. But ARK is not betting that they're going to. ARK is betting on these other companies that have been overlooked that are going to. And if she's right about that, those are going to be the new Apples in the future. She also says that the S&P has a record high valuation of about 26 times its previous, and NASDAQ at about 127 times. So again, she's saying that the broad-based equity benchmarks, which are the S&P and NASDAQ, the sort of broad-based equity means they take an entire look at the entire market and put those equities and make a broad-based bet on how the market is going to perform. That's how you kind of measure the market from a traditional sense, are going to underperform because they are not recognizing the $200 trillion opportunity that exists within these innovative tech stocks. And as a result of that, because they are so highly valued at 26 times for the S&P, 127 times for the NASDAQ, and innovation stocks are down 40% for the year, that's where her thesis argument is being made that these stocks are not in a bubble. Broad-based equities are in a bubble, and because they're not understanding the disruptive innovation that's happening within these tech stocks, and because she does, or her team does, their research suggests that it does, the Wright's Law, the S-curves, all these things are converging together at a time where they think in the next 5 years it's actually going to explode and change everything about how society operates. That means that there is a huge market opportunity to buy the dip. This is not financial advice, but that's basically what this article after 24 minutes said. It was a very well-worded article, but the whole point of it was buy the dip because this is ridiculous. The S&P is valued at a ridiculous level. If anything, that's in a bubble. But these stocks that are now this overvalued because of the sell-off, because of these fears of inflation that are eventually going to go away over time with deflation, that means that it's not in a bubble, and that means that it's in a pretty good deep value territory. So those are my thoughts on what Cathie Wood said. Really good article. I love when they release this type of stuff. I love analyzing this stuff and trying to break it down and trying to make sense of it. Let me know what you guys think. Do you think innovative stocks are in a bubble? Do you think they're actually going to change the world? And do you really think there is a potential $200 trillion market opportunity based upon the research that Cathie has presented around the handful of stocks that she's picking on to change the world? Let me know what you guys think. My name is Amit. I'll see you in the next one.